Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris rapeseed, Winnipeg canola and Malaysian palm oil markets. I'll start with Paris rapeseed. There have been, as I've repeatedly said since my annual review on Paris rapeseed back at the very start of January this year, there have been some big patterns in operation here. If I may refer to my commentary from the start of 2022, and I quote, "This leads to my final points. Since May last year," so that is May 2021, of course, since May last year, we have formed a newer, much more acute bull channel, and that's currently 682.25 to 910.75. To me, it is super acute and thus unsustainable, but it is there and I will not dismiss it just because of the acuteness. End of quote. Well, what I initially saw as a super acute bull channel is still there, and I've transferred it and finessed it here on this daily chart, such that I see it now more as the February/April 2021 to date larger ascending broadening wedge pattern, rather than a bull channel. This pattern has been the outlying corralling, if you like, bullish influence on this market, despite what may be happening on a daily or even a weekly basis. This pattern had been showing the way higher all the time. In the past, there had been some moves up and over the upper trend line, for example, during April, even trading full weeks above and outside it. But, and this is an important but this was and is a monthly pattern we're talking about here. And we've not had two monthly closes, consecutive closes outside it. We had only the one back in April, and prices fell to close below the lower trend line in June. Yet here we are now, testing again the lower trend line, repeatedly. The key pieces of action that have been holding up prices here are the 50% Fibonacci line in December 2020 to April 2022 move at 644 even, and the March 21 to date uptrend currently at 641.75. The first one is surprising as it is untested. The second also for the same reason. And that is just simply an uptrend. It's also just simply an uptrend and nothing more than an uptrend. Surprising. I will now refer to some comments I made 2 weeks ago about the recovery from testing the 50% Fibonacci line and uptrend, and I quote, "We've seen prices since slowly move higher, but it has been a tortured process, and I suspect that the overhead long moving average, currently at 722.5, which had earlier proved to be little if any support, may now not only be resistance but likely significant resistance. I suspect the lower wedge trend line may be revisited again and maybe soon." End of quote. All these things have come about, and we are now in a situation where the market is being forced to make a decision, whether to break upwards through the long moving average, which it seems reluctant to do, or whether to break down through the 50% Fibonacci line and uptrend combination, which it also seems reluctant to do. Thus, we could be building a bearish halfway hesitation for all this, hesitation, or we could be building a base. It is too early to say which it will be. Winnipeg canola. For a number of weeks, prices tried to go down through the long moving average. That's currently at 1020.80, but only managed it 4 weeks ago, and when they did, the fall was quite fast. I suspect this was due to the congestion from January and earlier between 945 even to 1037.70 not being as high a quality as they initially looked. Even the 50% Fibonacci lines of the January 21 to April 2022 move at 921.70 and the October 2020 to April 22 move at 863.80 failed to stop the flow lower. Prices only really started slowing around the August 21 low at 817 even, and the congestion just below at 808.60. Now, I also suspect that the very acute broken bearish Andrews pitchfork for the late April to mid-May move, which I reinstated recently, and which has guided the market lower, also guided it from being even more acutely bearish than it already was. Now you see, I'm not a fan of acute or super acute pitchforks, but you can see that the lower tightness currently at 705.70, stopped the low on Friday 2 weeks ago. And the middle time currently 773, even managed to hold the market up last week, but on a closing basis only. Then this week the market has been hassled from above by the descending upper time, currently 840.30. The market now has to make a choice. Either follow the broken but still seemingly effective bearish Andrews pitchfork lower, or break the upper time and maybe go sideways perhaps to test the May to date downtrend, currently at 911.60. The market has probably until this time next week to make up its mind. Bursa Malaysia crude palm oil. Now, after a stuttering start back in early June, the late April to late May bearish Andrews pitchfork has guided the move lower. Specifically, the market's desire to stay close to the middle time, currently at 36.33. The upper time, currently 43.15, and the lower time, currently 29.51, also played their part, more recently by guiding rather than being tested. Looking below, last week and this we have seen the unusual support of the big old head and shoulders neckline from the September 2015 to November 2017 move at 37.77, being tested and giving way. We next have the June 21 low at 33.26 and the January 21 low at 32.50. But I suspect they may not be as powerful as their monikers suggest. The reason for this is that just below, in a 28.50 area, we have target X, the potential target for the June to date bearish halfway hesitation. Only a proper break, and I mean a proper break, of the upper time would allow even the opportunity for this market to go sideways. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.